If you were watching gold on Wednesday and suddenly saw the price explode by roughly $100 in less than an hour, you were watching something much bigger than a normal market move. Gold jumped $100 in about 45 minutes after a major announcement from the U.S. Treasury. Silver moved higher at the same time, bond yields dropped, the dollar weakened, and suddenly the entire precious metals market started pricing in a very different economic story. This was not simply another gold rally. It was a signal that investors are becoming extremely sensitive to U.S. debt conditions and long-term interest rates. The question now is simple. Was this one explosive move the beginning of something much bigger? The move happened on Wednesday, August 19th. Gold surged by about $100 per ounce in roughly 45 minutes. The catalyst was a U.S. Treasury announcement involving larger buybacks of longer-term government debt. Reports showed that the Treasury planned to increase the size of its buyback operations for 10-year through 30-year Treasury securities. That announcement immediately changed the bond market. Yields fell, gold jumped, silver recovered sharply, and investors started asking whether the financial system had just entered a new phase. This is important because gold does not move in isolation. Gold is deeply connected to interest rates. Gold is connected to the US dollar. Gold is connected to government debt. Gold is connected to inflation expectations. Gold is connected to investor confidence. When one of those major forces suddenly changes, the market can react within minutes. That is exactly what happened. For much of the previous session, the bond market had been under pressure. Long-term Treasury yields had climbed to levels that were creating problems for risk assets and for precious metals. Higher yields normally make gold less attractive because gold does not pay interest. If investors can receive a higher return from government bonds, then the opportunity cost of holding gold becomes larger. But then the Treasury announcement changed the equation. The Treasury said it would increase its longer-term bond buybacks. The plan was expected to begin in September. The operation was designed to improve liquidity and support the market for longer-dated government debt. The immediate market reaction was powerful. Treasury prices moved higher, yields moved lower, gold moved sharply higher. Think about what that means. Investors had been worried about rising long-term yields. Suddenly, the U.S. Treasury was stepping in with a larger buying program. That created a new expectation about liquidity in the bond market. It also created a new debate about the future path of U.S. borrowing costs. And gold traders reacted immediately. This is why the 45-minute move matters. The market was not simply buying gold because traders suddenly became optimistic about precious metals. The market was reacting to a change in the perceived relationship between U.S. debt and interest rates. That distinction is critical. When gold rises because of a simple inflation report, the move can fade. When gold rises because of a geopolitical headline, the move can reverse once fear disappears. But when gold rises because investors are questioning the long-term structure of government debt and currency policy, the trend can become much more persistent. That is where this story becomes extremely interesting. Gold has already been showing strong momentum. By Friday, August 21st, gold was trading around the $4,600 area in some markets. Futures finished the week with a gain of more than 5%. Silver also finished strongly with futures near $70 per ounce. That tells us the $100 surge was not an isolated event. It became part of a much larger move. The US dollar is one of the biggest pieces of this puzzle. When the dollar weakens, gold becomes cheaper for buyers using other currencies. That can increase international demand. More importantly, a weakening dollar can tell investors that confidence in the purchasing power of the currency is changing. This does not mean the dollar is suddenly collapsing. That would be an exaggeration. But the recent weakness matters. Reports showed the dollar had fallen about 1% against a basket of currencies since Tuesday. At the same time, gold was moving sharply higher. That combination is important because gold and the dollar often move in opposite directions. Now add U.S. government debt to the picture. U.S. government debt has passed $40 trillion. That enormous number changes how investors think about future fiscal policy. The bigger the debt burden becomes, the more important interest rates become. Even a small increase in average borrowing costs can create a major change in government interest expenses over time. This is why long-term Treasury yields matter so much. If yields rise too quickly, financial conditions can tighten, mortgage rates can rise, corporate borrowing costs can rise, government financing costs can rise, stocks can come under pressure, emerging markets can feel stress, and gold can sometimes benefit from the fear that policymakers will eventually need to respond. The Treasury buyback announcement therefore created a very unusual situation. The government was effectively increasing demand for longer-dated debt. That helped push bond prices higher. Higher bond prices mean lower yields. Lower yields reduce the opportunity cost of holding gold, and gold responded almost immediately. The move was so fast that traders who were watching the market in real time could see the change, almost like a switch being flipped. One moment, gold was trading in a relatively normal range. Then the announcement hit. Then bond yields moved. Then the dollar reacted. Then gold exploded higher. That sequence gives us an important lesson about modern precious metals markets. The headline is not always the real story. The real story is often hidden one step behind the headline. The Treasury announcement was the headline. Bond yields were the transmission mechanism. The dollar was another transmission mechanism. Gold was the final expression of the market response. Silver is even more interesting. Silver is not simply a smaller version of gold. Silver has both monetary demand and industrial demand. That means silver can react to changes in investment demand while also responding to economic expectations. When gold breaks higher, silver often follows. But silver can move much faster. That is because the silver market is smaller and more volatile. A relatively small increase in investment demand can produce a large price response. Silver had already been showing strong movement around the $65 to $70 area. During the Treasury-driven rally, silver moved back above $65 and continued to strengthen. This is important for anyone watching the gold-to-silver relationship. When gold starts breaking higher because of monetary and fiscal concerns, silver can eventually receive a second wave of demand. The first wave usually goes into gold. Gold is the traditional monetary metal. Then investors start looking for additional upside. That is where silver can become extremely interesting. But there is a warning here. A sharp move does not automatically mean the next move must also be higher. Markets do not move in straight lines. After a huge rally, traders often take profits. Short-term traders can sell into strength. Technical indicators can become overextended. Headlines can change quickly. Bond yields can reverse. The dollar can recover. So the question is not whether gold can move higher. The better question is what conditions would allow the move to continue. There are several forces worth watching. The first is long-term Treasury yields. If yields continue moving lower, then the environment can remain supportive for gold. If yields suddenly surge again, then gold could face pressure. The second is the US dollar. If the dollar remains weak, then gold becomes more attractive internationally. The third is Federal Reserve policy. The Fed remains extremely important because interest rates influence the entire financial system. Markets are constantly trying to predict what the Fed will do next. Will rates stay high? Will rates eventually fall? Could inflation remain sticky? Could economic growth weaken? Could financial stress force policymakers to become more supportive? These questions can move gold before the Fed actually changes anything. That is why you should never watch only the Fed announcement. The market often moves before the announcement. Sometimes the biggest move happens because traders change their expectations. This is also why the latest Fed minutes matter. Recent Fed communication has not been completely friendly to gold. Some policymakers have remained concerned about inflation. That creates a difficult situation. The Fed wants inflation under control, but the financial system also needs stable borrowing conditions. Those two goals can conflict. If inflation stays high, then cutting rates becomes difficult. If economic growth weakens, then keeping rates high becomes more dangerous. And if long-term Treasury yields become uncomfortable, then the pressure becomes even greater. This is where the idea of the Fed being trapped can become relevant. The Fed may want to keep policy restrictive, but markets may start demanding easier financial conditions. The Treasury may want stable long-term borrowing costs. Investors may want protection from inflation. Consumers may want lower mortgage rates. Businesses may want cheaper financing. Government debt holders may want stability. These forces do not always point in the same direction. Gold often benefits when investors believe policymakers have fewer easy choices. That is one reason the current rally deserves attention. The market is starting to focus less on one simple question about whether inflation is rising or falling. Instead, investors are asking a bigger question. How does the United States manage a massive debt burden while keeping inflation under control and maintaining confidence in the dollar? That is a much bigger question. And gold is often the asset investors use when they want protection against uncertainty surrounding that question. Central bank buying is another major factor. Central banks have been important buyers of gold in recent years. The motivation is straightforward. Gold does not depend on the creditworthiness of another country. It is not a government liability. It can serve as a reserve asset. That makes gold attractive when governments want to diversify their reserves. This structural demand can create a foundation under the gold market. It does not guarantee higher prices, but it can reduce the amount of gold available when investors are already buying aggressively. Then there is geopolitical risk. Gold has always responded to uncertainty. War, trade tensions, political instability, energy disruptions, financial stress. These events can increase demand for safe haven assets. The recent environment has included ongoing geopolitical concerns and uncertainty around energy markets. Oil prices have also been influencing inflation expectations. Higher oil prices can create new inflation pressure that can complicate the Federal Reserve outlook. This creates another interesting conflict. Higher oil prices can increase inflation. Higher inflation can keep interest rates higher. Higher rates can pressure gold. But geopolitical fear can increase safe haven demand for gold, so the same event can push gold in opposite directions. That is why the market can become extremely volatile. Now let us return to the move that started this entire story. Gold jumped $100 in 45 minutes. That is not normal price action. It shows that liquidity can move extremely fast when the market receives a major macroeconomic signal. It also shows why traders need to understand bonds. Many gold investors spend hours watching the gold chart. That is useful. But if you want to understand why gold is moving, then you also need to watch the 10-year Treasury yield. You need to watch the 30-year Treasury yield. You need to watch the dollar. You need to watch real yields. You need to watch inflation expectations. You need to watch Federal Reserve expectations. Gold is a financial asset. It reacts to the entire financial system. The technical picture also deserves attention. After the sharp rally, gold pushed above important recent resistance zones. Momentum improved dramatically. The metal moved back toward levels that had not been seen since early June. Reports showed spot gold moving above $4,500 and later futures trading above $4,600. That tells technical traders something important. The market has changed from a defensive recovery into a stronger momentum phase, but resistance is still important. If gold continues higher, then traders will likely watch the next major psychological levels around $4,700 and $4,800. Above those levels, the market could begin looking toward the $5,000 area. That does not mean gold must reach $5,000. It means the psychology changes when a market approaches a major round number. At the same time, a sudden reversal could send gold back toward previous breakout areas. That would not necessarily destroy the bullish trend. A market can move higher while still experiencing sharp corrections. This is especially true after a move of $100 in less than an hour. Now consider what happens if the dollar continues to weaken. Foreign buyers may find gold more attractive. What happens if long-term yields remain contained? Gold loses one of its biggest traditional headwinds. What happens if investors become more concerned about government debt? Gold can become a hedge against fiscal uncertainty. What happens if central banks continue buying? That creates additional structural demand. What happens if the Fed eventually moves toward lower rates? That could further reduce the opportunity cost of holding gold. Put all of those pieces together and you can understand why the market is paying attention. But there is also a bearish scenario. Suppose inflation remains stubborn. Suppose the Fed becomes more hawkish. Suppose Treasury yields rise sharply. Suppose the dollar rebounds. Suppose investors start selling gold after the huge rally. Then gold could correct. Silver could fall even faster because silver is more volatile. That is why chasing a vertical move can be dangerous. The goal is not to predict every candle. The goal is to understand the forces behind the market, and right now those forces are changing. The most important lesson from the $100 move is not simply that gold can rise quickly. The lesson is that the bond market can trigger massive moves in precious metals. That is something many investors ignore. They look at gold, they see a price, they see a chart, but behind that chart is a massive global market for government debt. When Treasury yields move, the opportunity cost of gold changes. When the dollar moves, the international price of gold changes. When inflation expectations change, the demand for protection changes. When Fed expectations change, the entire valuation structure can change. And when all of these forces move together, the result can be explosive. That is exactly what we witnessed. The next question is whether this move can continue. If gold holds above its breakout area and silver remains strong, then the market could continue testing higher levels. If long-term yields remain controlled, then the bullish case becomes stronger. If the dollar continues to weaken, then international demand could remain supportive. If fiscal concerns grow, then gold could attract even more attention. And if the Federal Reserve becomes more supportive later in the year, then the market could receive another major catalyst. But if the Fed stays hawkish and yields rise sharply, then the rally could face a serious test. This is why the next major economic data releases matter. Inflation data matters. Employment data matters. Consumer spending matters. Economic growth matters. Fed speeches matter. Treasury auctions matter. And of course, the bond market itself matters. Sometimes the most important signal is not a headline at all. It is the movement in yields. That is why the next time you see gold suddenly jump $20 or $50 or even $100, do not immediately ask what happened to gold. Ask what happened to bonds. Ask what happened to the dollar. Ask what happened to real yields. Ask what changed in the expectations for Federal Reserve policy. That approach can completely change the way you understand precious metals. Gold is not simply a metal, it is a reflection of confidence. Confidence in currencies, confidence in governments, confidence in financial markets, confidence in monetary policy. When that confidence changes, gold can move very quickly. And the fact that gold moved $100 in 45 minutes is a powerful reminder of that reality. Silver may be even more interesting from here. If gold continues to climb, then silver could attempt to close the gap. Silver has a much smaller market than gold. It also has strong industrial demand. It is used in electronics. It is used in solar technology. It is used in advanced manufacturing. It is used in many applications where substitution can be difficult. So if investment demand rises while industrial demand remains strong, the silver market can become very tight. That is why silver can sometimes outperform gold during powerful precious metals rallies. But silver also carries greater downside risk. A 5% move in silver can happen much more easily than a 5% move in gold. That means investors should respect volatility. The bigger opportunity can also come with bigger risk. The important thing is to understand what is driving the move. Right now, the story is not simply inflation. It is not simply the Fed. It is not simply geopolitics. It is a combination of debt concerns and bond market conditions and dollar weakness and monetary policy expectations and safe haven demand. That combination is what makes the current environment so unusual. The Treasury buyback announcement may have been designed to improve market liquidity, but the market interpreted the move through a much wider lens. Investors started thinking about debt. They started thinking about yields. They started thinking about liquidity. They started thinking about the dollar, and they started thinking about gold. That is why the reaction was so powerful. The market is telling us something. Investors are paying much closer attention to the stability of the financial system. Gold is responding to that concern, and silver is beginning to respond as well. So what should you watch next? Watch long-term Treasury yields. Watch the dollar. Watch Federal Reserve expectations. Watch inflation. Watch gold around its recent breakout levels. Watch silver around the $65 to $70 zone. And most importantly, watch how these markets react to new information. Because the next major move may not come from the Fed. It may come from the bond market. It may come from the Treasury. It may come from inflation data. It may come from a sudden change in dollar expectations. That is what makes this market so fascinating right now. The $100 move was not just a number on a chart. It was a warning about how quickly the market can reprice risk. And if the underlying forces remain in place, then we could see more large moves ahead. Gold has already recovered dramatically. Silver is showing renewed strength. The dollar has weakened. Long-term Treasury yields have become a central focus. U.S. debt concerns are growing, and investors are increasingly looking for assets that can protect purchasing power during periods of uncertainty. Gold has been doing that job for thousands of years. The question now is whether this new phase of the market has only just begun. If you own gold or silver, then this is the part of the story you should pay the most attention to. Do not focus only on the daily price. Focus on the system behind the price. Watch bonds, watch the dollar, watch the Fed, watch inflation, watch liquidity, and watch the reaction of gold and silver when these factors change. Because the biggest moves often begin before the average investor realizes what is happening. And Wednesday gave us a perfect example. One announcement, one shift in bond expectations, one sudden change in yields, and gold jumped $100 in 40